sources of finance. This topic, we shall be looking at the various methods of financing business activities. For this topic, we shall be discussing the different methods of financing companies' assets. To appreciate this topic, if you look at the definition of financial management, to appreciate this topic, if you look at the definition of financial management, we define financial management as the management of companies' finances. Look at this. The management of companies' finances with the aim of achieving the company's objective. That is one definition of financial management. The second definition, or another definition of financial management, is financial management can be defined as the process of sourcing finance and utilizing finance the process of sourcing finance and utilizing finance so as to meet the objective of a business organization. If you look at that definition, financial management is concerned with how companies source finance. That means as a finance student or as a finance professional or as a finance manager, you must understand how company can source finance. You must understand how the company can source finance. It means you cannot go to this exam without a good understanding of the success of finance. An important aspect of financial management, an integral part of financial management, is the choice of the method of financing companies' assets. I'll repeat that. A critical aspect of financial management is the choice of the method of financing companies' assets. Companies use a variety of finance sources. Companies use a variety of sources of finance. Company can use equity financing. Company also use debt financing. Under the debt finance, company can use short-term debt finance. Company can use medium-term debt finance. Company can use long-term debt finance. That means companies use a variety of finance sources. Now, the question you ask yourself is, why do companies use variety of finance sources? If you pick a typical company, you are going to see equity finance, preference share finance, long-term debt, short-term debt, medium-term debt. Now the question is, why do companies use different types of finance? Why not stick to one? The purpose or the reason why company uses variety of finance sources. The reason why companies use a variety of finance sources is to achieve an efficient capital structure. If you find yourself as a finance manager, you are going to adopt different types of finance in your company. The objective is to achieve an efficient capital structure. At what point do we say a capital structure is efficient? Three conditions or three criteria must be satisfied for you to describe a capital structure as being efficient. Three conditions or three criteria must be satisfied. One is the capital structure should provide a suitable balance between long-term and short-term finance. You must balance your finance between the long-term financing and short-term financing. Some monies are some finance are needed for day-to-day running of the business. This will fall under short-term finance. Some finance are needed for long-term capital assets. This will fall under long-term finance. So the capital structure must contain a suitable balance, must provide for a suitable balance between short-term and long-term funding, should provide for adequate working capital. I'll repeat that. An efficient capital structure should provide for adequate working capital. And number 3, the capital structure should provide a satisfactory balance between equity and debt capital. That is why companies use a variety of finance sources. All right. We are looking at sources of finance tonight. We can categorize finance sources into 2. You have the equity finance sources, and you have the debt finance sources. You can categorize finance sources, sources of finance, into 2 groups. You have the equity finance sources, and we have the debt finance sources. Tonight, we shall be looking at equity financing. What are the sources of equity financing? What is equity finance? Finance provided by the owners of the company. Money contributed by the shareholders of the company. That is equity finance. Under the equity financing sources, we have 1, retained earnings. Under equity finance sources, we have retained earnings. What is retained earnings? You can define retained earnings as the percentage of companies' distributable profits. Percentage of companies' distributable profits that is retained and reinvested in the business. Where a company has retained earnings, then the company can use the retained earnings as a source of finance. Where a company has retained earnings, then the management can adopt retained earnings as a source of financing. There could be several benefits with retained earnings. One is the finance is readily available. The money is already in the company. For example, a company made a profit of 100 million after tax. A company, XYZ, made a profit of 100 million after tax. 50% is paid as dividend. 50% is retained in the business. That means the company has retained 50 million. That retained earnings can be used as a source of finance. The money is readily available. The do not require the approval of shareholders in order to utilize retained earnings. The directors of the company do not require shareholders' approval so as to use retained earnings to finance projects. Also, retained earnings is without issue cost. No issue cost is involved in retained earnings because the company is not issuing new shares. So retained earnings is a cheaper source of financing. Retained earnings is a cheaper source of financing. This will fall under equity finance. However, there could be limits to the amount of earnings available for retention. However, there could be limits to the amount of earnings available for retention for 3 reasons. For you to talk of retained earnings, the company must be profitable. For you to talk of retained earnings, then that company must achieve profits. And the profit should be large enough. Where a company is not making profit, then you cannot retain any earnings. Number two limitation with retained earnings. Retained earnings must be used efficiently. Please, just 1 minute. Thank you. Just to take water. Retained earnings must be used efficiently to provide a suitable return on investment. Otherwise, shareholders will demand higher dividend payments. Let us explain that. If a company is retaining earnings, then the company should use that earnings, the retained earnings, efficiently to generate sufficient return to the investor. If you are retaining my money, please remember, retained earnings belong to the shareholders. If the directors are retaining this earning, the money should be invested efficiently to generate return for investor. Where directors cannot invest this money efficiently, then shareholders will demand higher dividend payment. Number 3 points. Earnings are either retained or paid out to shareholders as dividends. Earnings are either retained or paid out to shareholders as dividends. By retaining earnings, a company is withholding dividend from shareholders. If a company retains earnings, what you are doing is you are withholding dividend distribution to shareholders. Now, where a company has a dividend policy, where there is a dividend policy, shareholders might have expectation about what future dividends should be. In other words, dividend policy could be a limitation to the amount of earnings retained. Dividend policy could be a limitation to the amount of earnings a company can retain. Because once you establish a dividend policy communicated to your shareholders, then you cannot go back and start retaining their money. All right. We have explained retained earnings as a source of equity financing. Number two, we have long-term finance and working capital management. How does this translate to source of equity financing? We said long-term finance and working capital management. Improvements in working capital efficiency. If there's improvements in working capital management, for example, efficient inventory management, explain dividend policy. Kemi, better relax. That is the next topic after this class, after source of finance. Dividend policy is a topic on its own. All right, let's continue. Where you have efficiency in inventory management, efficiency in trade receivable collection, efficiency in trade payables management. This efficiency in working capital management could lead to one-off source of finance, could provide a one-off source of financing to the business. If you are able to manage, your inventory very well, you are able to manage your trade receivables very well, you can generate a cash flow on one-off basis that you can use to finance your business. If your customers pay on time, that means there's efficiency in trade receivable collection. If you're able to achieve efficiency in inventory management, that means you are not tying too much cash to inventory. Through this process, you can generate a one-off source of equity financing. So I've explained we have explained retained earnings under equity financing. We have explained efficiency in working capital management. Number 3, issue of new shares. Yes, merchant bank. What kind of merchant bank is this?
Good evening, sir. Sorry, sorry, sir. I just need a little explanation. Yeah, good evening, sir. Please, can you just do a little recap on this long-term finance? I didn't get it properly.
Okay. We said long-term finance and improvements in working capital management. What is working capital? What are the components of your working capital? Your working capital is finance required for the day-to-day running of the business. What are the components of working capital? Your inventory, your trade receivables, your trade payables. Now, your inventory requires finance. At times, you invest a lot of capital in your inventory. That means you are tying down capital to the inventory. Now, if you are able to achieve efficiency in inventory management, by so doing, you are going to avoid tying down too much capital to inventory. If you are able to achieve efficiency in trade receivable collection, when you make sales on credit, that will give rise to trade receivables. That trade receivables must be funded. If your customers pay, if you're able to collect your money from your customers promptly, that means there's efficiency in trade receivable collection. This efficiency could give rise to a one-off free cash flow that could make cash flow available to you, because you are not tying down cash to trade receivable. You are not tying down cash to inventory. Therefore, the process will enable you, a company, to generate a one-off source of financing. This one-off source can be used to fund investment. Hence, we can adopt this process as a source of financing. Is it better, please?
Yes, sir, it is. Thank you.
So, in summary, If you find yourself in a company where you have to deal with inventory, you have to deal with trade receivables, you have to deal with trade payables, you must be able to manage those components very well. Otherwise, you are going to tie your money down. All right. Number 3, issue of new shares. Companies can issue new shares so as to raise finance. Companies can issue shares, equity shares, with the intention of sourcing finance. There are 3 ways company can issue new shares with the objective of raising additional finance or sourcing a finance. There are 3 ways companies can issue new shares with the objective of sourcing finance. Number 1 is public offer, also known as offer for public subscription. What is public offer? This is the issue of new shares to the general investing public. A public offer. This is the issue of new shares to the general investing public. This method can only be used by publicly quoted companies. Please underline that word. A public offer can only be used by a publicly quoted companies. And usually, companies will go to public offer if the amount involved, if the amount of money involved is substantial. If a company is planning to raise a substantial amount of money and the company is a publicly quoted company, that is, the company is listed in the stock exchange, then the company can do public offer, issuing of new shares to the general investing public. Like if you look at 3 months back, like 3 to 4 months back, Zenith Bank, Fidelity Bank, FCMB, they went into public offer, issuing their shares to the general public. The objective is to source finance. It should be noted that the issue cost associated with public offer is very high. The cost of public offer is high. So the method is best used if you are trying to raise a substantial amount of money. That is number 1. Company can issue new shares to raise funds through public offer. Number 2 is placing. Suraju Karim, what's happening to your network? You have been off and on. We have placing, also known as private placing. A placing. This is the issue of new shares. It involves issuing new shares to a relatively small number of selected investors. Private placing. This is the issue of new shares to a relatively small number of selected investors. Usually, we call them institutional investors. Institutional investors. Placing can be used, or is usually used, when a company is planning to raise a small amount of money and the cost involved is relatively low. The cost of placing is cheaper than the cost of public offer. Placing can be done by public companies. Placing can also be done by a private company. The shares will not be, the company will not announce issuing shares to the public under private placing. The company source buyer for its shares privately by doing placing. It is not announced to the general public. Please note, although placing is cheaper, it could give rise to dilution in ownership. When you place your shares with small investors, when you issue shares to a small number of investors, these investors can buy the whole shares. One investor can buy the whole shares. That means ownership structure can change. Percentage of ownership can change over time. And that can lead to dilution in ownership and control. Number 3, we have, okay, look at it again. A placing is an arrangement whereby instead of offering the shares to the general public, sponsoring investment bank arrange for most of the issues to be bought by a small number of investors, usually institutional investors. What are the advantages? It's cheaper. Placing are likely to be quicker means of raising finance. You can raise finance quickly through the means of placing. Placing are likely to involve less disclosure of information. However, most of the shares will be placed with a relatively small number of investors, which means that most of the shares are unlikely to be available for trading. That can give rise to dilution. Then number 3, rights issue. What is rights issue? This is the issue of new shares. Rights issue is the issue of new shares to existing shareholders. Issuing new shares to existing shareholders, usually at a reduced price. It says rights issue. This will fall under equity financing, whereby company offer shares, new shares, to existing shareholders. Rights issue is an offer to existing shareholders, enabling them to buy more shares in the company, usually at a price lower. Usually at a price lower than the current market price, and in proportion to their existing shareholdings. That is right issue. Companies, for a company to talk of right issue, that means the company must have shares in existence. You must have shareholders in existence. For a company to talk of right issue, that company must have shareholders in existence. That company must have shares in existence. The existing shares must have a stock market price. We are now issuing new shares to existing shareholders at a reduced price. Yes, Zoom user. Please tell me your name now.
This is Tolu. Good evening, sir.
Yeah, Mr. Tolu. Welcome, sir.
So, sir, I want to ask, is it possible for, I just thought of it, is it possible for one to have a mix of, let's say, public offer and right issue?
Yes, sir, it's very possible.
Okay, sir. Thank you, sir. That's what I just wanted to ask.
It's very possible. A company can say, I want to do public offer. At the same time, I'm going to do right issue. Zenith Bank did it. Sometime in March, I'm not sure, sometime in March, Zenith Bank did public offer. At the same time, right issue. Both methods were used simultaneously so as to raise finance. Yes, Tolu? Okay. Any question again? I can see Tolu. Okay, the same Zoom user, Abi.
Yes, sir.
Okay. You can go on. Now let us explain. We have explained the different methods you have under equity finance. You have retained earnings, improvements in working capital management, issuing new shares in order to source finance, under public offer, placing, rights issue. Let us discuss some or other features of rights issues, other terms associated with rights issue. One of them is the theoretical ex-right price. One of them is the theoretical ex-right price. Please listen to this very well, because calculation will apply here. Theoretical ex-right price. When a company announces a rights issue, when a company announces a rights issue, the market price of the existing shares is called the cum rights price. When a company announces a rights issue, the market price of the existing shares is called cum rights price. The theoretical ex-right price is what the share price ought to be in theory. What the share price ought to be in theory after the right issue has been completed. In other words, the theoretical ex-right price is the estimated share price. The estimated share price following the completion of the right issue. It is calculated as the weighted average price of the current shares, cum rights, and the issue price of the new shares in the rights issue, calculated as the weighted average price of the current shares, cum rights, and the issue price for the new shares. In your exam, you are likely to calculate in the exam. You are likely to have calculations coming from that angle. All right. The other aspects to be discussed, you know, when we define rights issue, we said issuing new shares to the existing shareholder, usually at a reduced price. It's a rights issue, not an obligation. It's a right. The existing shareholders are given the right to subscribe for more shares in the company. The shareholder has a choice whether to subscribe or not to subscribe. The shareholders have a choice whether to subscribe or not to subscribe. That takes us to the shareholders' choices. There are 4 options open to shareholders. When a company announces a rights issue, when a company announces a rights issue, there are 4 options available to shareholders. Option 1, the shareholders can take up the rights and buy the new shares fully. You can take up your rights and buy the new shares fully. You can buy the new shares. Option 2, the shareholders can renounce the rights and sell the rights to the market. The shareholders can renounce the rights and sell the rights to the market. By selling the rights, the shareholder is selling to another investor the right to subscribe for the new shares as the issue price. By selling the rights, the shareholder is selling to another investor the right to subscribe for the new shares at the issue price. Option 3, shareholders can take up some of the rights and renounce some of the rights. Option 3 is a combination of option 1 and 2. Then option 4, the shareholders can decide to ignore the rights and do nothing. You can decide to ignore the right issue and take no action at all. Note, shareholders are likely to suffer reduction in investment value when they choose to ignore the rights. Shareholders are likely to suffer reduction in investment value if they choose to ignore the rights and take no action. We are done with the explanation on equity finance success. While we await your question, please refer to your study pack. Question number 1, sources of finance. While we await your question, refer to the study pack. Question 1, Banco.
Page what, sir?
I should have
139.
139, have you?
Yeah.
You should be going to choice of finance now. Page 139, question 1. Page 139, question 1. While we await others to open their question, please give me 1 minute. I will be back. Please, 1 minute. Yeah, let's go on with the class. Question 1, page 39. How is it going on? I'll read. Banco is a stock exchange listed company that is concerned with its current level of debt finance. It plans to make a rights issue and to use the fundraise to pay off some of its existing debt. Please listen to this question. All right. Banco is a stock exchange listed company that is concerned with its current level of debt finance. It plans to make a rights issue and to use the fund raised to pay off some of its existing debt. The rights issue will be at 20% discount to its current ex-dividend share price of 7 naira 50 kobo per share. Look at it. The rights issue will be at 20% discount to the current share price. Banco plans to raise 90 million naira. Please underline. The company believes that paying off some of its debt will not affect its price earning ratio, which is expected to remain constant. Next, statement of profits or loss. You have the revenue, you have the cost of sales, You have the profit before interest and tax. You have the interest, profit before tax, your tax, and profit after tax. Statement of financial position. Ordinary share in brackets, ₦1 nominal value, total amount 60 million. The reserves, long-term liability, 8% bond in bracket, ₦100 nominal value, total amount 125 million. If you look at this statement of financial position, this company is financed by ordinary share capital and 8% bond. If you look at this statement of financial position, this company is financed by equity and debt. Equity is ordinary share capital. Our debt is bond. That means this company is a geared company. The next note. The 8% bond is currently trading as 112.5 per 100 naira bond. Let me explain that. That means the current price of a bond is 112 naira 50 kobo. The nominal value of a bond is 100 naira. When we say nominal value, the amount written on the bond, on the face of the bond, is called the nominal value. But at the market, is currently trading for 112. The bondholder have agreed that they will allow Banco to buy back the bond at this market value. Banco pays tax at a rate of 40% per annum. Requirement A. Calculate the theoretical S-right price per share of Banco following the rights issue. Look at requirement 1. Calculate the theoretical S-right price following the rights issue. You now ask yourself, you want to calculate theoretical S-right price. First is, what is theoretical S-right price? You know, you are required to calculate theoretical S-right price. Now try to define the concept to yourself. What is theoretical S-right price? Theoretical S-right price this is what the share price ought to be. The expected share price or the estimated share price following the completion of rights issue. What the share price ought to be after the completion of the rights issue. Now, how do we calculate theoretical S-right price? Please note, Please note, you require 4 variables. You require 4 variables to calculate theoretical S-right price. What are these variables? Let us go to our solution page. What are these variables? One is the current market price of existing shares. Please look at the question. What is the current market price of the existing shares?
$112.5.
Is that share? Examiner say bond is trading at 112. A bond is not a share.
₦1.
1 naira. That is not the current market price. That is the nominal value. Please come with me. Examiner says the current SD share price of how much? 7 naira 50 kobo per share. Look at it. The rights issue will be at 20% to its current XD share price of 7 naira 20 kobo per share. The current market price per share is 7 naira 50 kobo. You pick this figure. ₦7.50. Next, number of existing shares. How many shares do we have in existence currently? How many shares?
60 million.
Thank you. Look at it. To get it, ordinary shares, nominal value 1 naira, total amount 60 million. To get the number of shares, total nominal value 60 million divided by nominal value per 1 naira. Number of shares in existence is total nominal value 60 million divided by 1 naira. That is, we have 60 million shares in existence. Next, what is the right price? What is the issue price in that right issue? Come to the question. Examiner says the right issue will be at 20% discount.
Let's be at 6%.
Thank you. You are going to discount 20% to the current share price of 7 naira 50 kobo. Discount 20% from 750. What do we have?
6 naira.
6 naira, thank you. Look at it. The current price is 7 naira 50 kobo. I will remove 20% discount. That means I'm left with 80%. Find 80% of 7 naira 50 kobo. That will give you 6 naira. Alternatively, you can compute 20% first of 750. When you compute, now deduct the figure from 750 kobo. Then the last variables, number of new shares in that rights issue. How many new shares are we going to issue under the rights issue? We are not giving directly. How much are we trying to raise?
90 million.
90 million.
Look at
Yeah. So we're issuing
90 million. The company plans to raise 90 million naira at a price of 6 naira per share. How many shares do we need to issue?
50
At
million.
6 naira, that will equal 90 million.
15 million shares.
Thank you, Grace. Look at it. So we are not giving the number of new shares, but we are told the amount the company wants to raise. The company wants to raise 90 million. At a price of 6 naira per share. How many shares do we need to issue? At 6 naira, that will equal 90 million naira. Just do a walk back. 90 million divided by 6 naira. The company must issue 15 million new shares. New shares. These 4 variables are needed for you to calculate theoretical S-right price. When you have gotten the 4 variables, now go to your schedule. Open your schedule. You have column 1, the items. Column 2, the quantity. Column 3, the price. Column 4, the total value. Existing shares. Quantity, number of existing shares, 60 million. What is the price per existing shares? We are refer to the market price, please, not nominal price. Price per existing share, 7 naira 50 kobo. New shares, quantity, 15 million. Price per new shares, 6 naira. Now get your value. 60 million multiplied by 7.5.
450 million.
450 million. 15 million multiplied by 6.
900
90
million.
90 million. 90 million. 90 million.
90 million. Now, sum your quantity, sum your total value. Quantity of shares,
75
75 million.
and 540.
Total value, 540 million. Theoretical X right price is equal to total value over total quantity. That is let's work this out.
7.2.
7 naira 20 kobo. That is the theoretical extract. That is the theoretical X-right price. Any question, please? Yes, any question? If there's no question, let's continue.
Hello, sir.
Yes, please.
So now, when the total number of shares, the nominal value will be as 1 naira. Hello, sir. Can you hear me?
Please, can you go on? I can hardly hear you. What are you trying to say?
Now, the total number of shares they are having is 75 million number of shares.
Yes.
What will still be the
completion of the right issue. Number of shares is now 75 million.
Okay. Yes, sir. Now, what will still be their nominal value per share if they want to put this in their balance sheet?
The nominal value will not change. 1 naira per share. Balance sheet is maintained as book value. Regardless of whatever happened in the market, your statement of financial position will be maintained at the nominal value. Is that clear, please?
Yes, sir.
Requirement B. Or requirement 2. Calculate and discuss whether using the cash raise, let me take that again. That network is fluctuating. Requirement 2 says calculate and discuss whether using the cash raised from the right issue to buy back the bond is likely to be financially acceptable to the shareholders of Banco. Commenting on your answer on the belief that the current price earning ratio will remain constant. Now, to appreciate this question, this company is planning to do right issue. That means the company is planning to issue more equity shares to existing shareholders. That means equity value will increase. The money generated from the new shares will be used to repay debentures. That is buyback. We are going to buy back the debentures. That means we are going to repay the debt. That means the company's debt will reduce. equity will increase. Now the question is, would this proposal, using the cash raised from the rights issue to buy back the bond, is it likely to be financially acceptable to the shareholders? Would the shareholders accept this decision or this proposal? You now ask yourself, what matters to shareholders? What matters to shareholders is increase in their wealth. Whatever decision the company is taking, shareholders are particular about maximizing their own wealth. Whatever decision the company is planning to take, what matters to shareholder is, how does this affect the shareholders' wealth? The next question will be, what represents wealth to shareholders? Let me ask the class. Assuming you are a shareholder in a company, what constitutes wealth to you? Let me get a feedback from the students.
High dividends.
Your dividend per share, great. What other things?
Any per share.
Earnings per share, thank you. That's great. To the shareholders, the earnings per share is very important. It is from the earnings per share you are going to derive dividend per share. So to answer this requirement too, you are going to calculate earnings per share before the proposal, then earnings per share after the proposal. To answer this requirement too, you are going to calculate earnings per share before the proposal, then earnings per share after the proposal. We can now compare the earnings per share, whether it is increasing or decreasing or it remains the same. Is that better, please? All right. So now I'm trying to clean. My finger is a bit watery. Oh, I'm checking this. Any question? You are feeling slippery. Let's go on, John. Make sure you are writing in class name. Now let's go to this. First. Okay, look at it. Look at the comments here. Financial acceptability to shareholders to buy back the loan notes. The financial acceptability to shareholders to buy back the loan notes can be assessed by calculating whether shareholders' wealth is increased or decreased as a result of the decision. The nominal value of loan to be redeemed. I'll come back to this, don't worry. Let's come here. You want to calculate earnings per share. Pick, you have the current position and the revised position. The current position is before the proposal. What is the company's earnings per share? Then after the proposal, what is the company's earnings per share? You start with your profits before interest and tax. Check the statement you are giving. Means equal to 49 million. This is 49 . $49 million. Revised position. This will not change. It's still 49 million. Let me explain this. Before the proposal to issue more shares and repay the debt, the profit before interest and tax is 49 million. After the company has issued more shares and used the money to repay the debt, your operating profit will not be affected, because issuing more shares to repay debt is a financing activity. Recall, if you are doing your cash flow statement under your FR, if you have to prepare cash flow statements, you have operating activities, you have investing activities, you have financing activities. From your operating activities, you are going to derive the operating profits. Profits before interest and tax. Issuing more shares to repay debt is a financing activity that will not affect your operating profits. That means our operating profit, which is the profit before interest and tax, is not affected by the decision to issue more shares and repay the existing debt. 49 million, 49 million. We now take interest. Interest here will be 10 million. What is the interest here? Please listen again. Interest must change because we are going to bring in more equity. We are going to repay the debt. That means the debt will reduce. Is that not, please? Hello?
Yes, sir.
You are going to issue more equity. The money realized from the equity will be used to repay your existing debt. That means the debt will reduce. Reduction in debt will lead to reduction in interest expense. Point clear, please. Is that point clear, please?
Yes, sir.
Good. Now, by how much will our debt reduce? Let's go to the question. Currently, the bond is, look at the bond value, nominal value, 8% bond. The value is 125 million. Now we are going to raise equity on the right issue. We are going to generate 90 million. Can you see it? This 90 million, we are going to use it to repay our debt. The amount we have is 90 million. But we need to determine the nominal value of the debt to be repaid. This 90 million we have. What is the nominal value of the debt to be repaid? Please come here. Please look at this last paragraph. The 8% bond is currently trading at 112 naira 50 kobo per 100 naira bond. That means the current price per bond, one bond, is currently trading at a price of 112.5. The bondholder have agreed that they will allow Bar and Co to buy back the bond at the market price. You are going to buy one bond for 112. Now, if you have 90 million naira, how many bonds can you repurchase? You are going to buy back one bond at 112.5. Assuming you have gotten 90 million naira, how many bonds can you repurchase? The class is silent.
90 million bonds divided by 112.5.
Thank you. Please, the price of one bond in the market is 112.5. You have gotten 90 million. You are not going to ask yourself, how many bonds can I repurchase? You are going to divide 90 million divided by 112.5. Okay, look at it here. I will come here. I've gotten 90 million. I can buy one bond at 112.5. How many bonds can we repurchase? 800,000 bonds. That is the number of bonds you can repurchase. What is the nominal value per bond? Because it is the nominal value. Let's look at it. Look at it. 100 naira nominal value. The nominal value of one bond is 100 naira. You are going to repurchase 800,000 bonds. What is total nominal value of the bond? 800,000 multiplied by 100.
800
Look
million.
at it, please. That will give me 80 million. Look at it. Nominal value of loan notes to be redeemed. That is the bond, please. It's also called bond. You come here, 800,000 bond multiplied by 100 naira per bond. That will give you 80 million naira. That is the nominal value of bond to be repurchased. Outstanding bond, out of 125 million bond, we are going to repurchase 80 million. We are left with what? 45 million. This is the nominal value of outstanding bond. You are now going to calculate interest. You know, it's like you have repaid 80 million nominal value. The bond is now 45 million naira worth. You now compute interest on nominal value. Please note, interest is calculated on nominal value. Look at it. 8% of 45 million. What is the interest paid with this? On the outstanding bond. How much?
3.6 million.
3 point what?
3.6 million.
That means the interest is now 3.6 million. 80 million has been repaid. The remaining debt is now 45 million. The interest is now 3.6 million. You have 3.6 million. Please compute your profits before tax. This is 39 million. What do you have here?
45.4.
Now calculate your tax. 30% of 39 million. What is the tax payable?
11.7 million.
11.7. Next, calculate tax on the reverse position. 30%
13.62.
of how much?
13.62.
Now get your profit after tax.
$27.3 for current.
27.3
and 31.78 for revised.
31.78.
78.
Now, we want to calculate earnings per share. Earnings per share is calculated as the profit after tax divided by number of ordinary shares. So we have gotten profit after tax. What is the number of ordinary shares? Before the right issue, what is the number of ordinary shares? Hello, guys.
60
For
million.
and 75 million.
Before the right issue, how many?
60 million. 60
Thank
million
you.
and 75 million for reverse.
There is 60 million shares. There is 75 million shares. Please compute your earnings per share. You better concentrate on the lecture. If you want to sleep, just try. You can ask questions.
0.455 for current.
For the first one.
Yes, sir. 0.455.
Here we have.
Can we approximate it to 0.46?
Yes, it's allowed. But whatever you do here, you must do it here also. So if you are approximating to 0.46, what do you have here now?
0.42.
0.40. Can you see what I... Before the proposal, the earnings per share is 0.46. That is 46 kobo per share. If the company issues new shares and use the money to repay the debt, earnings per share will fall. That will be a concern to the shareholder. Examiners say price earning ratio will remain unchanged. Examiner said, assuming the price earning ratio remain unchanged. That means price earning ratio is equal to market price per share over earnings per share. Earnings per share. We can calculate this. We know the current market price per share. The current market price per share is 7.50 naira. And we have calculated the current earnings, 0.46. If I want to calculate current market price per share, current price earning ratio. The market price is 7.50 naira per share. Current earnings per share, 0.46. Please compute the current price earning ratio.
16.3.
15 points.
16.3.
This is currently 16.3. So we have 16.3. Market price per share currently is 7.50 naira. Examiner says, assuming that the earnings per share remain unchanged after the proposal, that means this will still be 16.3. The question says, assuming the earnings per share remain unchanged. That means the earnings per share, the price earning ratio before the proposal is the same as the price earning ratio after the proposal. Okay, people are waiting for me at the queue. Let me admit them. That means this ratio will not change. With this arrangement, we can derive what the market price will be after the rights issue has been completed. We can derive the market price per share after the company has completed the right issue and use the money to repay the existing debt. Look at it, please. Look at this. Price earning ratio is equal to market price per share over earnings per share. I'm not saying this ratio will be 0. No, this ratio will remain 16.3. Market price per share. Under revised, we don't know. Look at under revised.
Yes.
We don't know market price per share. But we know the earnings per share to be, let me create small space. Let me create, okay, I can let me create more space. I can pick this away here. Okay. After the proposal, earnings per share is still 16.33. Market price per share, I don't know after the proposal, but I know the earnings per share to be 0.42. I can cross multiply. Is that not? That means revised market price per share is equal to 16.3 multiplied by 0.42. Please work this out.
6.85.
Revised market price per share, 6.85. Look at it. Based on the price earning ratio, that means under revised, this will be 6.85. Now, at this scenario, assuming you are the shareholder, before the proposal, your earnings per share is 0.46, and the market price of your share is 7.50 naira. If the company issues right issue and use the money to repay this debt, your earnings per share will go to 0.42, and value per share will be 6.85 naira. What will be your reaction, the shareholder? Yes, hello.
I will not be happy. I won't be happy.
The shareholder will not be comfortable with this arrangement.
Yeah, because there is a significant drop.
Yes, value per share has dropped. Earnings per share has dropped. These are what represent wealth to the shareholders. The question says, calculate and discuss whether using the money raised from the right issue to buy back the existing bond will be financially acceptable to the shareholders, assuming the price earning ratio remain unchanged. With these arrangements, with these results, the decision to use the money from right issue to repay the existing bond will not be financially acceptable to the shareholder. Given this result, the shareholders will not be comfortable with the arrangements. We are done with the computation. Please, after the class, carefully study how we dealt with the question, particularly how we determine nominal value of the debt repurchase. These are likely examiner questions. Yes, this is coming to some of us, or to most of us for the first time. But it's something that you can learn. Look at the comments. Even theoretically, calculated theoretical strike price, the expectation is that it should be 7 naira 20 kobo. This price is even less. Look at the comments. The share price is less than the theoretical strike price. That is the revised share price. This revised, better that way. This revised share price is less than the theoretical strike price. So the effect of using right issue funds to redeem the bond, some might get confused. It's also bond. Loan is also called bond. To redeem the bond is to reduce the wealth of the shareholders. From the shareholders' perspective, this use of funds cannot be recommended. From the shareholders' perspective, this use of funds, using the fund raised from the right issue to repay the existing bond, cannot be recommended. However, the conclusion depends largely on the assumption that price-earning ratio remains constant, as the ratio was used to calculate revised share price from the revised earnings per share. In reality, the share price after redemption of loan notes will be determined by the capital markets. It is this market determined share price that will determine the price earning ratio. Since the financial risk has reduced, do you understand that point? By repaying your debt, the financial risk of the company will reduce. Since the financial risk has reduced, following redemption of loan notes, the cost of equity is likely to fall, and the share price is likely to rise. That means our computation is based on the assumption that price earning ratio will not change. In reality, it will change. Because we use the market price per share to calculate price earning ratio, not the revised share price. So if the share price, if assuming we have the market share, is assuming after the completion of the right issue, we know the market share price. And this market share price is above the theoretical right price. Then the shareholders will experience capital gain. In this case, using the right issue funds to repay the existing debt will be financially acceptable because the wealth of the shareholder will increase. The last aspect, you can take the notes here, boss. The last question is, compare and contrast the financial objective of a stock exchange listed company such as Banco and the financial objective of non-for-profit organization such as large charity. Please, these are likely questions in your exam. These are some of the things that happens at the introduction to financial management. What is the financial objective of a stock exchange listed company? The financial objective of a stock exchange listed company is to maximize the wealth of the shareholders. So companies are in business to maximize the wealth of the owners. Why the financial objective of a not-for-profit making organization is to provide services to the public. The not-for-profit organization, their objective is not to make profit. They are established to provide public services or charitable services. Although they are established to provide public service, this service requires funding. This service required cash income. To provide water, you must fund water. To provide security, funding is required. That means cash must be attached to these activities. Therefore, maximizing the net cash income is a financial objective for not-for-profit organization, as well as for listed company. Large charity seek to raise more funds as possible in order to achieve its charitable objective. Which are non-financial. You can please read more about this, and please more seriously, this material I'm sharing with the solution, particularly the theories, please go through it and try to understand how to reproduce in exam. All right, we have to stop here. We are done with the question.